I'm going to do is just give you an example. Mr. and Mrs. Jones, age 50, they want to retire in 15 years and they make $100,000 per year. Before we lay out the particulars of their example, I'm going to establish that there are three basic types of investments. And today we're going to talk about these investments in terms of buckets of money. The first bucket is what we call the taxable bucket, meaning every year as your money grows, you get to pay a tax. How do you know if you have a taxable investment? Well, every year the IRS sends you that little love letter. It's called a 1099. It says, hey, your money grew this much. Now you got to give a portion back to the IRS in the form of taxes. These are generally liquid investments, which means that they make for great emergency funds. What do financial experts tell us? We should have in our emergency funds about 6 months worth of basic living expenses. The second bucket is what we call the tax deferred bucket, meaning you don't pay taxes as your money grows. When do you pay the tax? At the very end, when you take the money out. What are some examples of some typical tax-deferred investments? 401ks, IRAs, SEPs, Simples, 403bs. You guys get the idea. Now, there's all sorts of different rules that apply to these investments, but generally speaking, they all have two things in common. First thing they have in common is when you put money in, you get a tax deduction. For example, you make $100,000 per year, you put $10,000 into your 401k. What's your new adjusted gross income? That's right, $90,000. Second thing they have in common is the manner in which they're taxed upon distribution. Now, the IRS has a special word that they use to characterize this income when you take it out. What do they call this income when you take it out? They call it ordinary income. Ordinary income, what does that mean? That means that when you put money into your 401k, at what tax rate are you taxed when you take that money out? At whatever tax rates happen to be in the year you take that money out. So folks, isn't that a little bit like going into a business partnership with the IRS? And every year the IRS gets a vote on what percentage of your profits they get to keep. Does that sound like a good business partnership to anyone? So you could have $1 million in your IRA, but unless you can accurately predict what tax rates are going to be in the year you take that money out, do you really know how much money you have? The answer is no. And it's pretty hard to plan for retirement if you don't know how much money you have. And the third bucket we're going to talk about is what we call the tax-free bucket. Now, there's all sorts of different investments out there that masquerade as tax-free, but I'm here to tell you to be truly tax-free, it's got to qualify in two different ways. The first way is it's got to really be tax-free. When I say tax-free, I'm talking free from three different types of taxes: free from federal tax, free from state tax, and free from capital gains tax. The second thing we're looking for in a true tax-free investment is when you take money out, it should not count as provisional income. What counts as provisional income? Well, any distributions or any 1099s from your taxable bucket count as provisional income. Any distributions at all from your tax-deferred bucket count as provisional income, and 1/2 of your Social Security counts as provisional income. So the IRS adds all this provisional income up, and if as a single person, it adds up to more than $34,000, or if as a married couple, it adds up to more than $44,000, then guess what? Up to 85% of your Social Security can become taxable to you at your highest marginal tax bracket. All right, everybody pretty much in a good mood by now? Okay, so what we're going to do in the balance of our time is I'm simply going to give you an example. So let's say Mr. and Mrs. Jones have $500,000 in their IRA in the tax-deferred bucket. They've got $100,000 in some plain old taxable mutual funds in the taxable bucket. That's their emergency fund. They're putting 10% into their 401k, but they're getting no match, no company match, no free money. And they're putting $2,000 per year into some term life insurance, and they're putting $4,000 per year into some long-term care insurance. Now, if this couple were to walk into a traditional tax-deferred Paradigm Financial Advisor's office, how would the conversation go? Mr. and Mrs. Jones, congratulations. They always congratulate you. You're doing great. Problem is, last year when you were down the road at XYZ company, you only earned 7%. We think we can get you 8%. So roll all that money over to us. As far as your mutual funds, that's a great emergency fund. Problem is, last year down the road, you only earned 3%. We think we can get you 5%, so let us manage that for you as well. As far as your 401k with no match goes, keep on doing it. When you switch jobs, give us a call. We'll roll your 401k into your IRA, get everything under one roof, maybe save you some break points, save you some fees. And as far as your term life insurance and long-term care insurance goes, gosh, not really what we do. But who are we to say you shouldn't keep doing it? And that is a conversation that I've heard literally dozens and dozens of times. Well, when someone like that walks into my office for the very first time, I see red flags all over the place. For example, I'm not so much concerned with what's in this IRA today. What keeps me awake at night is what this IRA is going to be worth 15 years from now if it grows at 8% per year. It's now worth $1.6 million. Folks, did you know that if you had $1.6 million in your tax-deferred bucket, the required minimum distributions alone would put you in one of the higher marginal tax brackets and literally guarantee that your Social Security will be taxable in perpetuity with all of the compensating spend down that goes along with it. So what we want to do is we want to prevent that IRA from ever getting to 1.6 million, which begs the question, how can you prevent an IRA from growing? And don't anyone say, put it in the stock market. Well, one of my very favorite ways is to do what we call a Roth conversion. How many of you guys have heard of Roth conversion? Okay, so Roth conversion simply says that if you have money sitting in an IRA in the tax-deferred bucket, you can shift it to tax-free so long as you pay what along the way? Taxes at what rate? Whatever the rate happens to be in the year you do the conversion. So let's say Mr. and Mrs. Jones, they convert their entire IRA all in 1 year. I wouldn't recommend it. But let's say that they did, and they pay 40% tax. How much tax are they going to pay on that $500,000 conversion? $200,000. So here's the question. Do Mr. and Mrs. Jones have $200,000 just lying around that they can earmark for that tax bill? They don't have it. So what's the rule of thumb, folks? Unless you got a lot of money just languishing in your taxable bucket that you would happily earmark towards a tax on that Roth conversion, I would probably recommend that you wait until 59 and a half before you start thinking about Roth conversions, which of course begs the question, is there any way to get money out of that IRA pre-59 and a half without penalty? Well, at this point, I may bring up that little known section of the IRS tax code. It's section 72, subsection T. And a 72T says that you can take money out of that IRA pre-59 and a half without penalty so long as you do it in separate, equal, yearly distributions that last for at least 5 years or until 59 and a half, whichever is longer. So let's say Mr. and Mrs. Jones decide to do that 72T. That means they can take out of that IRA each and every year $25,000. They can then shift that to tax-free. Okay, let's look at those mutual funds. If that's their emergency fund, how do we feel about it? Do they have too much or too little in that emergency fund? What do you think? A little heavy, right? So if they make $100,000 per year, how much should they have in that emergency fund? Probably closer to $50,000. So not only do they have too much, but they're growing it in mutual funds, which means in theory the problem's getting bigger every year. So what we want to do is we want to take the growth on that mutual fund plus some of the principal, and we want to shift it to the tax-free bucket little by little, year by year, such that by the time they reach retirement, they got the perfect amount. I've done the math on this, folks. That would require an annual shift from taxable to tax-free of $6,000 per year. All right, let's take a look at that 401k with no match. The rule of thumb when it comes to 401ks is you put in up to the match, but not 1 penny above and beyond. You do whatever's required to get the free money, and then you move on to the next best thing. Well, if these folks are trying to prevent their IRA from growing by doing a 72T, yet they're putting money hand over fist into their 401k and they're getting no company match, are those two strategies at odds with each other? Yeah, that's a conflicted strategy. So what we want to do is we want to recapture that 10%. 10% of 100,000 is $10,000. We want to shift that to tax-free. And how do we feel about term life insurance and long-term care insurance? We feel like it's incredibly important to mitigate both of those risks, either one of which can really upset your financial apple cart in the years leading up to retirement. But we feel like sometimes, not always sometimes, there can be a better way to accomplish it. So we may recommend that we recapture that money as well. So how much total money did we free up on an annual basis to be able to reposition to tax-free? What does that all add up to? $47,000. Well, usually at this point, someone will say, hey, Dave, not so fast.